Welcome! In this video, can XCN coin come to 10 cents in the near future? We will analyze this. Don't forget to subscribe, like, and please watch to the end to understand.
Support zones are among the most closely watched technical levels in financial markets. These are areas where the price has paused multiple times in the past, where downward movement has weakened, and where buyers have stepped in to push the price upward. The price is currently in exactly such a support zone, one that has seen repeated reactions in the past. This indicates that it is a strong defense line recognized by the market. To understand the logic of a support zone, it is necessary to first look at market psychology. Every time the market price reaches this level, many investors see it as an opportunity point. This is because, in the past, the price has bounced upward from the same level, creating a chance for gains. Investors, trusting in this past experience, buy again. These purchases cause the price to move upward once more. If this cycle repeats several times, the support zone becomes even stronger. Strong support zones remain in investors' memories, and whenever the price approaches them, buying pressure automatically builds. In the current situation, the price is holding at a level that has been tested many times before. The fact that there have been multiple upward bounces from this level in the past shows that the market still sees it as valuable. If the price bounces again from here, it could be not only a short-term rise, but also a catalyst that shifts the overall market trend upward. In technical analysis, a strong reaction from a support zone often leads to the price reaching higher highs. Bounces from a support zone are not purely a price action phenomenon. Behind them are both psychological and supply-demand dynamics. As the price approaches the support zone, sellers' appetite decreases while buyers' appetite increases. Sellers hold off from selling because they believe the price will not easily drop below this level. At the same time, buyers act because they see it as a chance to buy lower. When these two behaviors combine, buying pressure builds in the market, pushing the price upward. Trading volume also plays a big role in the strength of support zones. If there was high volume trading at this level in the past, the zone gains even more significance. This is because large investors or institutions may have open positions here. These players do not want the price to fall below this level, so each time it returns here, they buy again to defend it. This defense increases the likelihood of the price turning upward. Currently, the price being in a support zone may cause investors to enter a wait-and-see mode. However, if the price holds here for several days or candles and then begins to move upward with increasing volume, this would be interpreted as a strong bullish signal. In such a case, market participants' confidence rises and more buyers step in. This chain reaction can cause the price to rise quickly. Support zones are also important for stop-loss levels. Many investors place stop-loss orders just below the support zone. This is a precaution to prevent further declines if the price breaks below the support zone. However, if the price bounces from the support zone and starts to move upward, these stop-loss orders are not triggered and no extra selling pressure enters the market. This makes the upward move easier. Strong reactions from support zones often lead to price movement toward the next resistance level. When the price bounces from here, the first target is usually previous highs. If resistance is broken, the trend can then turn into a larger upward wave. From a market psychology perspective, the majority of investors may be watching this level closely. Highly visible support levels create collective behavior. When hundreds or even thousands of investors try to buy at the same level, the price naturally moves upward. This is one of the best examples of technical analysis being a self-fulfilling prophecy. However, a bounce from the support zone is never guaranteed. If there is negative news in the market, strong selling pressure, or macroeconomic risks, the support zone can also be broken. This is why risk management should always be practiced. Still, the current attempt of the price to hold here is an encouraging sign for investors. If the price turns upward strongly from this level, it could mark the beginning of an uptrend according to technical analysis. Consecutive green candles, increasing volume, and upward signals from momentum indicators all raise the probability of the uptrend continuing. If such a scenario occurs, the move starting from the support zone could quickly turn into a strong rally, offering significant profit opportunities for investors. In short, the fact that the price is currently in a support zone and has bounced from here many times in the past increases the likelihood of a similar scenario repeating. Market participants are watching this level closely, and a potential bounce could be the beginning of a new upward wave. Therefore, whether this level holds or not will be one of the most critical factors in determining the direction of price movement in the coming days. But we can't decide on the analysis based solely on support. Let's also look at other metrics. Stay tuned.
The RSI, or Relative Strength Index, is one of the most widely used momentum indicators in the markets and serves as a tool that essentially takes the pulse of price action. Its main purpose is to identify overbought and oversold zones in price movements to anticipate potential reversal points. In the current situation, the RSI has reached a level that has been tested numerous times in the past. Interestingly, each time the RSI has reached this level, the price has moved upward. Therefore, being at the same level now increases the probability of another upward reaction. To understand this more clearly, it's worth recalling how the RSI works. The RSI is an oscillator that moves between 0 and 100, with readings above 70 generally considered overbought and readings below 30 considered oversold. However, focusing only on these two thresholds is not enough. The RSI also reacts to certain horizontal or trend lines. In other words, specific levels that have repeatedly caused the RSI to turn upward in the past act like hidden support areas for investors. Just like on a price chart, when these levels are retested, they tend to produce similar reactions. At present, the RSI is at a level that has previously led to upward price movements. This reflects the principle in technical analysis that history repeats itself. Most market participants see levels that worked before as another buying opportunity. When the RSI bounces from this area, the price typically gains positive momentum. This is because a rebound in the RSI from a low level indicates that buyers are entering the market. Another reason the RSI could bounce from this point is market psychology. Investors remember the upward moves that occurred at the same point in the past and believe a similar move could happen again. This belief increases buying pressure. Short-term traders in particular watch such technical levels closely and open positions as soon as they get a signal. This can cause the price to gain upward momentum quickly. In addition to predicting price direction, the RSI is also effective in evaluating trend strength. A rebound in the RSI from this level could mean not only a short-term jump, but also a strengthening of the current trend. Especially if the price chart is also near support zones or an ascending channel, the signal from the RSI becomes even stronger. These recurring reactions in the RSI usually follow a certain logic. For example, when the price repeatedly faces similar selling pressure within a given period, the RSI drops to a certain value, but after that, buyers step in. Many algorithmic trading systems and manual trading strategies interpret an upward reversal in the RSI at certain thresholds as a buy signal. This is one of the self-fulfilling prophecies of technical analysis. The current state of the RSI sends several important messages to investors. First, it means the market is either near the oversold zone or at a point with potential for a reversal. Second, the fact that there have been multiple rebounds from this level in the past indicates it is a strong technical support zone. Third, this type of alignment between price and the RSI is considered a reliable signal in technical analysis. If the RSI indeed turns upward from this level, price action could accelerate. An RSI reversal indicates that momentum has shifted from negative to positive. This means selling pressure is fading while buying pressure is increasing. At this point, a rise in trading volume is also an important confirmation signal. If volume increases, the reliability of the RSI signal improves and the likelihood of continued upward movement grows. That said, an RSI bounce becomes even more meaningful when analyzed alongside other technical indicators. For example, if the price is also at a support zone or at the lower band of an ascending channel, the rebound signal from the RSI has a higher success rate. Therefore, rather than tracking the RSI in isolation, evaluating it with price action and other indicators gives investors an advantage. In the market, such RSI reversals often create a window of opportunity, especially for short-term traders. This is because an RSI bounce from the bottom often coincides with the price entering a rapid recovery phase. In this process, the price first tests nearby resistance levels, and if resistance is broken, it can turn into a larger rally. An RSI bounce from such a level creates an expected reaction mindset among market participants. This expectation can cause buyers to act early and open positions before the price has fully turned upward. Sometimes this leads to a sudden price surge. If this move is supported by strong volume, the probability of continued upward movement increases. In conclusion, the current RSI level is a noteworthy point in terms of technical analysis. The fact that upward moves have started from this point many times in the past suggests that a similar scenario could unfold again. Of course, there is never certainty, but such recurring signals from technical indicators play a significant role in market participants' decision-making processes. If the RSI does bounce from here, it could be the first sign that the price will reach higher levels in the coming period.
The pennant pattern is one of the most well-known and most closely watched continuation patterns in technical analysis. When it appears after a strong upward move, it indicates that buyers in the market are still in control and that the price has the potential to continue its upward movement. In the current situation, we are also looking at such a pennant pattern. A breakout above the upper line of this formation could pave the way for the price to move slowly but steadily toward the $0.10 level. To understand the logic of the pennant pattern, it is first necessary to look at how it forms. The price makes a strong, steep upward move over a certain period. This rapid rise is often referred to as the flagpole. This is followed by a short period of consolidation in the market. In this consolidation phase, the price moves within a narrowing channel, usually slightly downward sloping or horizontal. This tightening structure is the pennant itself. The idea here is that new buyers entering the market during the rise are met by investors taking profits. However, the selling pressure does not significantly push the price down, only sideways or slight pullbacks occur. The most critical point of the pennant pattern is the upper line of this tightening range. This line represents the short-term resistance level ahead of the price. If the price breaks this line with strong volume, it means that buyers have regained control of the market. This breakout confirms that the pattern is indeed a continuation formation. In the current scenario, if the price can break above this upper line, we could see the pattern complete and a new wave of upward movement begin. When calculating the target price for this formation, the usual method is to measure the height of the initial flagpole and add this distance to the breakout point. In the current situation, the calculations suggest that the price could rise to the $0.10 level. This could be a gradual climb rather than a sudden jump. Some pennant patterns, once broken, do not immediately trigger a sharp rally. Instead, the price climbs step by step, reaching the target through small pullbacks and sideways moves. There are several factors that increase the reliability of a pennant pattern. The first is that there must be a strong trend before the formation appears. If there was no sufficiently steep and high volume move before the pennant, the pattern's strength is weakened. In the current case, there was a significant upward movement beforehand, which indicates that the formation is healthy. The second factor is that the consolidation period should not last too long. Pennants are generally short-term formations completed within a few days to a few weeks. A consolidation that lasts too long may indicate that momentum is fading. Here, the duration appears to be within a reasonable range. Trading volume at the moment of breakout is also crucial for the pennant pattern. An increase in volume shows that the breakout is supported by a genuine wave of buying. If the price breaks the upper line while volume remains low, it can create hesitation among investors and the breakout may fail. However, a breakout accompanied by high volume usually has a greater chance of reaching the target price. Investors who spot this pattern often follow similar strategies. Many buy once they see a close above the upper line. Some wait for an increase in volume during the breakout before entering a position. More cautious traders prefer to wait for the first small pullback after the breakout, a pullback entry, and buy from there. Despite these different approaches, the common goal is to benefit from the price movement toward the target. Looking at the psychological background of the pennant pattern, we see this. After a strong rally, the price turning slightly sideways shows that buyers are still strong but have entered a short rest phase. During this time, sellers cannot push the price significantly lower because demand remains high. Buyers wait for a new breakout opportunity. As the price moves within a narrowing range during this waiting period, it's like pulling back a bowstring. Potential energy builds up, ready to be released when the upper line is broken. The $0.10 target could be a particularly noteworthy level in the current market dynamics. This represents a significant percentage increase from the current price level. Such a rise could have a strong psychological impact on investors and attract more buyers into the market. These kinds of targets often materialize faster if the breakout's momentum prompts new participants to jump in. Additionally, this type of formation offers opportunities for both short-term and medium-term investors. Short-term traders often set several profit-taking points starting from the breakout. Medium-term investors may prefer to hold their positions until the $0.10 target is reached. Risk management is also important here. If the price falls back below the upper line after the breakout and closes there, the possibility of the pattern failing should be considered. Most of the elements needed for this pennant pattern to succeed appear to be present now.
There's a strong upward move beforehand, the consolidation period is ideal, the formation is clearly visible, and the target price calculation is logical. The only remaining requirement is for the price to break above the upper line with strong volume. If that happens, the market could enter a steady climb toward the $0.10 target. In conclusion, this pattern offers investors a clear roadmap in technical analysis. A breakout above the upper line will signal that the market has shifted back into buyer's control. In such a scenario, it is quite possible that the price will reach the $0.10 target slowly but surely. During this process, being patient, understanding the nature of the formation, and closely monitoring technical indicators will give investors an advantage.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analysis, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.